So how to consistently pick winning stocks. Now, this is very much about quality, value, and momentum. If you're a subscriber, you may know about this. But if you aren't, this is really very, very, very important in investing. Or if you're just new to us, really, really, this is so important to understand. So what was it about Rolls-Royce before it took off? Okay. Now, Rolls-Royce, it's one of the big, big, big winners in the UK stock market in recent years. And we've seen that you can see this is the StockRank line, which I'll explain in a moment, but it popped up to 88 and the shares really have rocketed up to, well, it was £8 when I last did this chart. It's actually they're now at about £10. And this is a huge defense. This is a huge defense theme that it's on, but it actually had certain core attributes, which I actually all through this webinar, it had all the attributes I'm going to be talking about right through its journey. And most fundamentally, it was very, very, what I would say, exposed to the three primary drivers of exceptional stock market selections, which is quality, value, momentum. And I repeat this all the time because it's so important and it's academically backed, as I'll share in a moment. But good quality shares are profitable shares. They're not story stocks. They're not stocks that have a hype and a bit of spin. They are genuinely profitable, cash generative, often asset backed, often stable businesses, and they tend to outperform the opposite. Value stocks are shares which are cheaper relative to very, very expensive ones. And cheaper stocks, value investing has been a big theme for a long time. And momentum is the thing that most private investors are very uncomfortable with, but which I hope in this webinar I can really change your mindset about, which is the idea of buying shares that are going up and not buying shares that are going down. And I've got a bit of a section on momentum later, which I think is really interesting. But very, very quick potted history from 1920 to 1980, quality, value, momentum. I say this a few times, apologies if you've seen this before, but it's really, really important to understand that there's a lot of history on these themes. And the first chap who actually really benefited from this idea of momentum was a guy called Jesse Livermore. Wonderful book called Reminiscences of a Stock Operator, which details his story. But he became one of the richest men on Wall Street, and he realized one simple truth: buy high, sell higher. Not buy low, sell high. Buy high, sell higher. And then he flipped it and he went, well, what if I sell short, low, and then buy back even lower? And so he made a fortune, and he ended up shorting the 1929 stock market crash and became one of the richest men on Wall Street. He was worth billions in today's money. But he became quite unpopular because of that, because other people like Benjamin Graham lost their shirt in the stock market crash of 1929. And Ben Graham lost so much money, he vowed never to lose money in stocks ever, 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 ever again. And therefore, he started perusing and musing on what it would take to never lose money in shares. And he really theorized that if he bought shares so cheap, they had a margin of safety to their intrinsic value that basically, even if the company went bust, he could sell its parts off and he'd still make a profit. And so he became this sort of like what we call deep value investor. He wrote a book called Security Analysis. And actually, if it wasn't for Ben Graham, you wouldn't have me. Not that I'm on his level, but I'm a chartered financial analyst. And the whole chartered financial analyst curriculum, it owes a huge debt to Ben Graham, because he taught security analysis and financial analysis at Columbia University to many, many people who went on to have hugely successful asset management careers. And his most famous student was Warren Buffett. And Warren Buffett started as a value investor doing just what Ben Graham did, buying super cheap companies. And actually, Berkshire Hathaway was one of those companies that he bought. And he was become the richest man in the world. But he became so rich off value investing, he couldn't find any cheap stocks that he could really buy in the size he needed to. So he started buying quality stocks like Amex, like Coca-Cola, like Apple more recently. Big companies that were so profitable, they could reinvest their profits back into their core, into their business, and grow and grow and grow. And they compounded in size to scale and made him an absolute fortune. So these were sort of anecdotal evidence that these themes of quality, value, momentum really worked, but it wasn't necessarily like rigorously understood. And then in the kind of 80s and 90s, we started getting database technology, and we started gathering data on all the companies and putting them in databases. And that put all these sort of academics to work. The academics, whose names you wouldn't really know, they started validating these core ideas. One of these guys, Eugene Fama, won a Nobel Prize. And really what he and his partner French found is that if you sorted the whole stock market from the cheapest stocks to the most expensive stocks, and you put them in little portfolios, you could actually, the cheapest shares actually outperformed the most expensive shares over time. And similarly, this idea of sorting the market for these traits, which you can measure, means that you then can craft portfolios that put these wonderful forces and return drivers, and they act as a tailwind on the shares that you buy. And this is kind of from their data library, Fama and French. The dotted line is the S&P 500 since 1990. And the green, blue, and yellow lines show portfolios using their data, not ours, and essentially investing in the top 10% shares ranked by those traits. And those portfolios have outperformed the S&P 500. And this is probably the most trusted academic research library that there is in the world. So, this is essentially what we understood when we founded Stockopedia and what we wanted to put to work. We wanted to help myself and other people be able to put this to work. So the stock rank is on all of our stock reports, as you'll probably know. And the stock rank is composed, it's a number between 0 and 100. And I'll show you in a minute, but it's composed equal weight from a quality rank, a value rank, and a momentum rank. And these three massive forces on stocks are ranked for every share in the market from 0 to 100. And we have a variety of components that go into these ranks. I'm not going to go into all the detail because I want to be respectful of everybody's time. But essentially in the quality rank, we measure what Warren Buffett would call the quality of franchise, which includes its profitability, its cash flow generation. It looks at also the margins and margin stability and growth. And you kind of get a general measure of the quality of franchise. We also look at whether the fundamentals are improving since last year. So there's a little bit of fundamental trend. And we also look to make sure it's safe from bankruptcy and earnings risk. So if you see a high quality ranked stock, it's got these general traits of being a good, profitable company, being improving, and also quite safe. And then for value, we rank value based on 6 financial ratios. You'll know the price earnings ratio, which is the price against what it earns. We look at various financial ratios and include the dividend yield and various others. But this multi-composite comes together into a really simple to understand value rank that actually outperforms a straight PE ratio when you use it. And it's also much more robust across different market cycles. And then we've got this momentum rank, which I'm going to talk about in a minute, so I'm not going to dwell on it. But in essence, you get these 3 stock ranks, which I'm sure if you're any of you, most of your subscribers, you will be using these all the time. But it's quite good to always get a refresher on these because these rank from 0 to 100, and they rank every share from 0 worst to 100 best. And the way to think about this is if you look at the value rank, this means that this stock is valued it's cheaper than 83% of other shares on the market. And if its quality is 98, it means it's higher quality than 98% of the market. So because you know these are percentiles, there's always 2% of the market above and 98% below. And then you've got the composite here, 99. Now, sometimes people say to me, Ed, how can this, my son said this the other day, he said, how can this be a 99 if the 3 ranks are lower than it? And it's because what we do is we actually sum all 3 and then we re-rank them out of 100. So this would be the quality, value, and momentum. This is in the top 1% for all 3. So that's good to know and understand. We've got lots of learning materials on how the individual ranks are composed. So do go and dig into the help section, and you can find out a lot more detail about each rank in particular. But they've all got terrific performance histories, and we've got all of that on the site. I can show you later. And generally, you find that the higher ranked quality, value, momentum, and overall stock rank outperforms. This chart just highlights the 90 to 100 UK ranked shares versus the 0 to 10 ranked shares over nearly 13 years of market history. And the FTSE All Share is here. And it's quite extraordinary. When we designed the system, we back tested this for a couple of decades. And we always found these charts. And it's just amazing to see them actually come out and fall out after 10 years of live tracking. This continually works. So the higher ranked sets of shares tend to do well. Now, that does not mean that every single high ranked share is like a buy recommendation or anything else. It's like a general tendency for those types of shares to do well. So if you see a kind of a share like Morgan Sindall, which is a 97 ranked share at the moment, these are the actual live ranks today. If you see a 97, it does not mean that share is going to go up by 15% in the next year. It means it's in a set of shares which has the traits, which if you own the whole set, the set might do well. Whereas, a Vactor might double. It might do really well, but it's ranked 1, which means it's in that lower performance set of shares. So when I kind of think about picking shares, I think I want to have a group of shares that's higher ranked because it gives me quality, value, and momentum drivers behind my portfolio. And I want to minimize the number of punts or gambles that I have in my portfolio, because I don't own a Vactor, but occasionally I have a low ranked share, which I know a lot about. And I just know that is one that is a bit more of my gamble. And I need to sort of lean on more my more unique insight. So you want to kind of load your portfolio more with higher ranked shares to be able to have more confidence of outperforming the market. Now, when you are buying higher ranked shares, this is we wrote an ebook on the StockRanks. You can find it in the Academy. But this shows the likelihood of picking a winner or loser by the stock rank. And you can see low ranked on the left, high ranked on the right. And red means that these shares were the percentage of these shares, 90 to 100 ranked shares, which were losers on a one or 2 year basis. And this is the number which were winners. So you can see in any kind of 1 or 2 year period, you tend to find that about 2 to 1 are winners in the highest ranked set. But if you look in the lowest ranked set, you're almost 3 to 1 against. And this is such an important point. If you look at your portfolio and they're mostly in lower ranked shares, you are fighting a huge headwind. You're fighting a huge headwind. The odds are really against you. Whereas if you've got higher ranked shares, you're more likely to have more winners in your portfolio. And in a year like this year, I think like in my portfolio, 17 out of 20 shares are winners. But obviously there are some years which are bear markets where, more like a 12 or 13 might be losers, and which can be really frustrating. But this sort of averages out over the full bull and bear market cycles. Anyway, I kind of say you've got the blue pill and you've got the red pill. And the blue pill, this is like from the Matrix, right? If you watch the movie The Matrix, I would say there is a blue pill, which is staying in the illusion that a great stock idea is out there that changes everything. It is true that there really are amazing share ideas out there. But if you leave yourself open to story stocks and narrative and bias and everything else, you might do well on one pick, but who knows, you might pick the wrong one. Whereas the red pill is like seeing reality as it really is. And the way I frame this is actually, although, nothing, you can fall in love with your shares. I really, really like all the stocks in my portfolio, but it's not about the stocks. It's about their characteristics. The trick and the real truth about outperformance is owning shares that have the right characteristics. They need to be systematically good quality, good value, good momentum, or some combination of the three. And that's what Ben Graham has done, and Warren Buffett's done, and all the great investors have done. They understand it's about those characteristics, but everybody kind of thinks it's kind of gets a bit hung up on the names. So that's really important. And I should have shown this slide earlier, but one of the wonderful things about StockRanks, this is a quote from Phil Hoffer. He relies on the stock ranks and the quality rank because he's not a trained financial analyst. And he said to me, I'm not someone who can dissect a balance sheet, but the stock ranks help me separate the wheat from the chaff. And so the strategy he's developed has helped him generate very life-changing returns. And he's done that without having to understand everything about a balance sheet. And I think it's really important. These return drivers are far more important than all the kind of complexity of financial analysis. And that's why I'm quite passionate about it. I think this stuff is really important.